Well, good morning, everyone. Welcome to the Foreign Correspondents Club of Japan here in Tokyo, and to the latest in what we call our deep dive events, in which we assemble panels of experts to talk about topics or to discuss topics of current interest. And today's topic, obviously, is Trump tariffs, the market movements, the dollar, and so on. And I think most people will agree these are certainly topics of current interest. I'm Anthony Rowley, I'm former president of the club, and I'll be acting as moderator today. And let me straight away introduce our three speakers in the order in which they will be speaking. To my left, immediate left, is Paul Sheard, who is well known, certainly lately, for being the author of the Wall Street Journal's best-selling book, The Power of Money. He's a former Harvard Senior Fellow and Vice Chairman of S&P Global. Joining us from Washington, D.C., yes, he's there, good, is Tran, who's a non-resident Senior Fellow at the Atlantic Council Geoeconomics Center. He's a former executive managing director of the Institute of International Finance in Washington, and he's a former deputy director of the Monetary and Capital Markets Department at the IMF, the International Monetary Fund. And last but certainly not least, to my right is Richard Katz, who is a well-established, well-known economist and author of the recently published book, The Contest for Japan's Economic Future: Entrepreneurs versus Corporate Giants. It was published in England in English, I think, last year, and it's recently been published too in Japanese. So, I'm going to quickly step out of the way for our panelists, but I think we journalists are in danger of running out of adjectives to describe what's going on at the moment. We're seeing massacre and mayhem in the marketplace. We're seeing travesty and potential tragedy in global trade as Trump tariffs take their toll. And we're seeing a looming threat of recession, economic recession, and possibly even depression, who knows. So where and when will it all end? That's the question we hope to provide at least some answers to today. So let me step out of the way and give the floor to our panel of experts, beginning with Dr. Sheard. Paul, if you want.
Thank you very much, Anthony, and let me say what a great pleasure and honor it is to be back here at the Foreign Correspondents Club of Japan, a wonderful storied institution, and Anthony and I go back, at least a couple of decades now, so great to be back here. Look, what I thought I'd do just in my introductory remarks is make sort of 3 points, but really start with the big picture. So first of all, I want to talk a little bit about how to sort of situate the Trump tariffs, the Trump administration, MAGA, America First, the whole kind of Trump phenomenon, if you like, of which the Tariff War Liberation Day is the most recent sort of incarnation. How to sort of locate that in a slightly bigger kind of framework for thinking about what's going on in the world. And then, being an economist, I can't resist the temptation to weigh in a little bit on the economics. I mean, covering US economy and Trump is kind of interesting for an economist, oftentimes frustrating, but you've got to get your kind of decoder ring out and trying to figure out what is actually the economic logic, if there is logic, behind many of the policy positions. So I want to just touch a little bit on some of the sort of analytical ideas from economics that might be useful in corralling some of the Trump ideas. And then the third one, just come back to the actual movements of the day and sort of how to interpret and understand what's going on as this volatility is playing its way out day by day. So to start with the broader context, and I started thinking this way back in 2016, when, again, as an economist, as an analyst, I was trying to make sense of what does this Make America Great Again, America First agenda mean? How do we sort of understand this? And what sort of came into my mind, or my sort of understanding, is to say that it's very easy to focus on Trump the individual. I mean, he just occupies our minds rent-free. Somebody made that nice kind of description. He's got the ability to just, how many people in the world? 8 billion people. There's one person who can drive the news cycle, capture everybody's attention. And that's, of course, President Trump. So But I see, you know, it's so easy to get like, sucked into that black hole almost. But stepping back and looking at the solar system or maybe the universe a bit more generally, I see Trump largely as a manifestation, as a symptom of other things that are going on in the global economy, the global order, etc. Now, what do I mean by that is that essentially I think the sort of predominant system that we've had in the post-war period, which you might call Pax Americana, has really reached its limits and is sort of starting to come unstuck. And I think a lot of what we hear from President Trump is kind of like a symptom, a manifestation of that. So what's going on here? Well, the idea, again, in a very short presentation, I'm going to be leaving out all the footnotes and you know, making broad, sweeping generalizations. Please forgive me in advance. But the idea of Pax Americana is to say that, well, in the post-war system, the US behaved as the benign global hegemon. Now, sometimes when I've said that, I've been challenged. People say, it's not so benign. But anyway, put that to one side. That is the sort of underwriter of global security and the liberal economic order of free trade. And put it a little bit more sort of in economics jargon, the US was the economy or the country that largely provided global public goods of security, you know, policemen to the world, keep the sea lanes open, sort of, you know, have a very strong military that, you know, people are afraid to kind of cross. And then, of course, to underwrite the sort of Bretton Woods, GATT, World Trade Organization, open liberal trading order as well. And so if you think about the US doing that, it meant sort of two things. One is that, particularly when it came to security, the US was providing a disproportionate amount of military spending. So on a GDP basis, military defense spending in the US is now about $1.1 trillion. That's about 3.7% of GDP. Now that's actually historically low. If you go back 30, 40, 50 years, it was much higher, 11%, 15%. So it's come down. But Japan, of course, historically spent more like 1% of GDP. The NATO countries, they've been trying to get up to the 2% line. Maybe half of them are sort of at least announcing 2%, but they're not really there. So the US is almost kind of double that amount. And if you look at the absolute numbers here, they're quite staggering. Military spending in the US on a GDP basis is about the total, a little bit more than the total of the next 9 countries combined. That's a dominant military superpower. Well, what's wrong with that is guns and butter. I travel the New York subway frequently. Now I have the pleasure in Tokyo of traveling the Tokyo subway. No prizes for guessing which one is third world and which one is, I have an affection for the New York subway, but it's a fun place in many ways. But guns and butter means if you spend more on military expenditure, you're spending less on the domestic infrastructure, the goods and services that make people happy. And so the US has been bearing a disproportionate share of that sort of burden of underwriting global peace or security, if you like. And that's one of the things that President Trump is kind of railing against. And on the economic side, on the trade side, there's a corollary to that, which is under the post-war system, the US tended to open its markets, the consumer of first and last resort. And other countries, particularly in the 50s and 60s and the post-war reconstruction, but then later on as well, the US was prepared to have relatively low tariffs and not necessarily demand. It would demand, but it wouldn't necessarily follow through on those demands for other countries to match those tariffs. So a lot of the world has higher tariffs than the US. So again, President Trump comes along and says, what's going on here? This is not fair. This is not symmetric. This is not reciprocal. And that's what we should be doing. We should be, now, you can either get to that point by lowering tariffs down to the US level, if not below, or raise them all up to the highest tariff, race to the bottom or race to the top. I know which I would prefer, but that's the kind of backdrop here that's going on. Now, why has that system changed? Well, a fundamental concept in international relations, which I don't specialize in, which is that every country acts in its national interest. So when people say America first, well, of course America first, Japan first. That's what every country is supposed to do. But so why was the US able to provide this different kind of role in the post-war order? Well, in a nutshell, because it was so big. And it was able to provide, or willing to provide, those global public goods of security and free trade, etc., also providing the world's reserve currency, the dollar, which again is another kind of public good, was prepared to do all of this because it was big enough to internalize those externalities that normally would lead to the under-provision of the public goods. But fast forward, China enters the WTO, starts experiencing massive economic growth. For a decade or so, was growing at 10% annually. That means its economy was doubling in size every 7 years. Now growth is down to a little bit below 5%, but still, it's now a major economy. The numbers here can be a little bit sort of confusing depending which ones you look at. If you just look at nominal GDP, the US is still the largest economy in the world. It's about 26% nominal GDP. China's about 17%. And then the next one is Germany and then Japan around about 4%. So these two economies now are clearly the two big economies in the world. If you look at it that didn't used to be the case. If you went back early post-war period, the US was more like 50% and China was, a statistical error. Economists, be a bit nerdish, tend to use, in making these comparisons, purchasing power parity. I won't bore you with the details of that. Basically taking into account the spending power of the currency in the domestic economy. And those shares go the other way. China's now 21% of the world economy by PPP, and the US is about 16%. Then comes India at 9%. Emerging markets tend to do better on a PPP basis. So that's really the basic point here, that this is an underlying kind of structural shift in the sort of geopolitical, the geoeconomic world, which is challenging the sustainability of that Pax Americana system. Now, what I see Trump is doing is, I don't think you could explain this with all due respect to President Trump. He'd probably lose interest quickly. But I think that's effectively his intuition, his gut feeling, and what he's railing against. Problem is, we can't expect President Trump to be the one to sort of fix and reform and rebuild this system. I think it really is up to the rest of the world. So rather, one of my messages is, maybe it's a little bit too rose-tinted glasses, is that rather than sort of wringing our hands all the time and our hair is on fire about all the terrible things President Trump is doing, is sort of to recognize, look, this is more of a manifestation. Let's focus on the key issues here. How do we build a new world order? Not a very nice word, but a world in which there is more joint provision of global public goods. Because President Trump may be good at destroying a system. I don't think he's going to be very good at building the new system. That's up to us. Now, let me just move on to... and how's the time going?
Yeah. You've got 15 minutes.
Left?
Yeah.
Okay, oh, wow. Okay. Even better, I thought. I think Anthony is in a particularly generous mood today, obviously. But there is an element, just not to dwell on this last point, of President Trump wanting to have his cake and eat it too. Having his cake means, he wants to correct all of these ills that he sees in the system. But he also seems to want to continue to enjoy the position of the US as the kind of, dominant player in the world. Some would say, kind of the chief bully in the world, in some ways, people would say. So I think there's already there within the Trump agenda a kind of, because he hasn't been able to define a real path forward, a kind of internal contradiction that, again, we have to struggle with. Now, let me say a little bit now on, take my geopolitical hat off and put on my economist hat. And just, so how do we understand, if we can, the kind of economic logic? Because we do need to understand those arguments and potentially counter them, or maybe sometimes say, maybe there's a germ of truth in some of these arguments. Let me just cite three kind of economic issues that crop up with the Trumponomics and the Trump agenda. One is the obvious one, that President Trump's ideas, and therefore the ideas that are being propagated by the administration, are very mercantilistic. They're pretty much at odds with economic thinking of the last 200 years or so. So mercantilistic means the president sees trade deficits as inherently a bad thing. Thinks that at least, well, I guess that these deficits should be, and bilateral, not just overall trade deficit, but the bilateral trade deficits, as being basically in principle bad. Now, economists would say, well, hold on a minute. They come about because there are different economies, different countries have comparative advantage. They have different stages of economic development. They have different demographic profiles. So different countries, so trade is, we trade within an economy, that makes us more prosperous, gains from trade. If we trade across economies, we can leverage even more the gains from trade and increase prosperity. And I think most economists, most people would look at the last 50 years in the post-war period as having proved that point, and the latest exhibit A or B would be China after the WTO entry was able to really participate in global trade and took off and grew rapidly. Not that China doesn't have its own problems, but big picture. Also, President Trump tends to see these deficits as a drain on national wealth, rather than as something that is kind of facilitating that. And this is really very quite heterodox economic thinking. Just to, one of the things, again, as an economist, when you hear all this rhetoric, President Trump and the administration, the media more generally, tend to talk about trade balances, surpluses, and deficits as if they're somehow disconnected from the rest of the economy, and somehow you can just pull some policy levers and you can, let's stimulate exports and let's suppress imports. And, you have some levers, you pull those levers and that will happen. Well, actually, it doesn't work like that. There's a useful kind of analytical device in economics, which I invoke quite a lot, which is the national accounting identity. And in a nutshell, what it says is that the excess of domestic savings over investment equals your current account balance. So if you're running, like Japan, a current account surplus, which is now about 3.6, 3.7% of GDP, what that means is, and if you're running a budget deficit, which Japan is, then the private sector is generating an excess of savings over its investment. So you may as well look at the now, it's the trade deficit. It's not really the trade balance here. It's the current account balance. That's a footnote. But just call it the trade deficit for argument's sake. That if a country's running a trade surplus, what it means is that they must have a domestic excess of savings, and vice versa. So you could just as well look at the problem in the US of this chronic trade deficit as reflecting the fact that there's not enough savings relative to the investment that's going on in the economy. And you could sort of try to solve the problem through that route. And, in some sense, if you don't do that, you're probably going to run into a few roadblocks. So, in other words, in this decentralized, largely decentralized economy, where you have hundreds of millions of consumers and producers, and everybody's making these decentralized economic decisions, somehow all of this stuff aggregates up to these very big macro variables that are very difficult to move. You can't wave a magic wand. President Trump is not an economic dictator or economic god. So that's a sort of point to bear in mind here. A second one, and again, okay, clock is ticking. Second kind of sort of economic point that comes up is this issue of who pays the tariff. So again, President Trump will claim that the tariffs are paid by China, Europe, Mexico, Canada, whatever. The American consumer doesn't pay the tariff. Now, not to put too fine a point on it, this is clearly nonsense. Again, there's a pretty clear economic analysis of this issue. And here you need to distinguish between a small country that imposes tariffs and a large country that imposes tariffs. So the US is a large country. So there are sort of two effects. Tariffs are a tax on imports. The imports are ultimately bought and consumed by the domestic consumers. So the tariff drives a wedge between the price that the producer is going to get for selling the product, and the consumer is going to pay. And the question then is sort of how is that wedge that between the two prices distributed between the consumers, the domestic consumers paying more, and the foreign exporters who sort of squeeze their prices down to try to keep their prices down to maintain their market share. And so at the very least, for an economy like the US, part of that incidence of the tariff, the tax, is falling on exporters, but countries like China, Japan, whoever. But probably most of it is falling on the domestic consumers in the US. But what economists, that's really an issue of distribution. Economists are quirky people. What economists typically worry about is not that issue so much of the incidence of the tariff or the tax, but rather what we lose sleep about at night is the so-called deadweight losses. That the real problem with tariffs is that it leads to less trade, it leads to less economic activity through the international trading system, and those gains from trade are lost. And this is the famous sort of Harburger triangle. And so that's just, we just never see that prosperity. We never see those producer and consumer gains. I just throw in Arnold Harburger, famous Chicago economist who happens to be still alive. He's one of these people that you know, in grad school, you learn about the deadweight losses, the Harburger triangle, and he's 100. He's 101 this year, and he's still alive. So a shout out to Arnold Harburger. I'm sure he's following this debate closely, even at that age. Then the last one I just want on the economics, kind of again, this is a longer list. I've just chosen 3 kind of economic points here to make. Is a thing called Triffin's dilemma. Triffin's dilemma is basically the idea, this goes back again decades to an economist called Triffin, and he basically the idea that if a country wants to be or is the reserve currency for the world, and of course we have the dollar as the dominant reserve currency. Reserve currency means a number of things, of course. It means at one level countries tending to want to manage their exchange rate against that currency, to varying degrees. Could be a fixed exchange rate, could be a managed float. Using dollars of that currency for invoicing, for international trade, for financing and investment as well. So a number of roles it has. But basically what the Triffin dilemma says is that if you're doing that, then you're going to need to run a current account deficit. Largest part of a current account deficit will be the trade deficit. And so, because you need to be able to continue to satisfy the appetite of the rest of the world to hold this reserve currency. And so you need to keep supplying that. One way in which that sort of happens as well, and close the circle, is that you'll tend to have a strong bid for dollar assets, which will keep a strong bid on the exchange rate. Stronger exchange rate will mean more imports and less exports. It kind of closes the circle. So again, you hear President Trump and members of the administration railing against the current account deficit, the trade deficit, but they still want the US to be the dominant reserve currency. Again, wanting to have your cake and eat it too. Now, all of this sounds rather bleak, and obviously these tariffs in particular could do an awful lot of harm. But I'm a little bit more sanguine about that issue. So let me now pivot into the third point I want to make, sort of how to understand, how to sort of put this together. Can we take these tariffs at sort of face value as, oh my God, we're stuck with 20, 30, 50, 100, China now, 104% tariff? I don't think so. I don't think I'm the only person to look at things this way, and I could be accused of being too rosy in my assessment. But what I see here, and again, if you read the, 100 executive orders that the president has already issued, which, for my sins I tend to do. I'm sure Richard does as well in Hung. I don't read every single one, but I get up in the morning, what am I going to do? Read the newspaper or read the executive orders? So I read the executive orders. And there's a sort of pattern here, which is the president identifies a policy that he wants to pursue. Now, the kind of good thing about Trump is that it's pretty transparent. Those policies are usually exactly what he campaigned on, and he's been going on about, for the last, 8 or 9 years since he's been in the political limelight. So we sort of know what he's been saying. He hates deficits. He wants to bring the manufacturing jobs back. He wants to kind of restore kind of integrity to the border. He wants to get other countries to pay their fair share. He wants them to open their markets and get rid of the deficit, all that stuff. So he says all that. So he says, that's my objective now. Bring those deficits down, bring the jobs back. Then he looks for a policy tool. And in this case, it's tariffs. And he says, okay, I'm going to now use this tool as leverage to get other countries, in this case, or it could be individuals, it could be companies, let's talk about countries with tariffs and companies, major companies, sort of threaten to use that tool to change their behavior in the desired direction, his desired direction, obviously. And so he threatened to use it, and hopefully the idea is force the opponent to sort of come to the table and negotiate, and we're already sort of seeing lots of examples of that. And then, pretty quickly get some concessions and then declare victory. I have the political win, and move on. And when sort of does that, sort of basically put the tool back in the box. Don't use the tool. So that's sort of the way I'm looking at this, that I think if in 3 to 6 months, famous last words here, I think most of these tariffs will be gone. Mm-hmm. And depending on how the world reacts, maybe could even have lower tariffs. I mean, you've got the EU and US now talking about, reciprocal zero tariffs, etc. Now, one of the flies in the ointment is the non-tariff barriers. If it was simply tariff rates, there'd be a really elegant solution, which would be to everybody get around the table and say, who's got the lowest tariffs? Let's all go to that low tariff. Breathe life into the moribund global trading system. But to get there, you have to first threaten to have high tariffs. Now, let me bring a little bit another of economics here, which is from game theory. When I watch President Trump, I see game theory in action. And the key concept, one of the key concepts in game theory, as opposed to, as applied to bargaining, is the idea that for a threat to be effective, it has to be credible. Now, credible has a particular technical meaning in game theory. What it means is that if I'm threatening Anthony, I'm threatening to do X to get him to do Y. Anthony has to believe that if he doesn't do Y, I am going to do X. If he believes that, and doing Y under my threat of X is better than not doing Y when I follow through with my threat of X, then he will do Y. And so, but if he says, hold on, Paul, I know you're just bluffing here, you're not really going to go through, that would be disaster. You'd blow up the global economy, blah, blah, blah. Surely you're not going to do it. Then he's not going to accede to my demands. So the trick is, the art of the deal, so to speak, is to convince people that no, tariffs is the most beautiful word in the English language. I actually want to impose tariffs. And then maybe the ploy will work. So that's the way I'm looking at things here. Could be wrong, but if I'm right, what it means is that pretty rapidly, a lot of these tariffs will come down, but it has to be in the context of Trump being able to declare victory and then move on. Got a pretty busy agenda. So I think I've hit
This is not a threat, but 2 minutes.
2 minutes, okay. So that's kind of, that's sort of my bold prediction. Now, I have to say, like talking to people in Tokyo and others, and we'll hear more on this panel, most people are surprised at that and think, oh my God, I mean, no, this, he really means that these tariffs are going to continue. It's going to be a disaster. But again, my point is that's exactly what he wants you to believe. He wants the Japanese negotiators to believe and the Chinese negotiators. The China situation will be the interesting one to watch, how that plays out. Just finally, a word on Japan. I can't help kind of just throwing in for the Japanese audience in particular. When was it? Thursday morning when we got the results of Liberation Day? It seems like a year away. But anyway, last week when the announcement happened. And I was a little bit wrong-footed by the reciprocal tariffs, because the reciprocal tariffs are not reciprocal at all. Far from it. They're reciprocal in the sense of including this estimate of the tariff equivalent of the non-tariff barriers. And that's really the key driver. And if someone's been around for a while, immediately sort of the ghosts of the 1980s and the 1990s of the structural impediments initiatives and the whole debate about Japan's non-tariff barriers around keiretsu and other business practices sort of came back to me. And it sort of all came washing back. But the flip side of that is to say that, Japan is relatively well placed here, not just because it's now way down the list of, in terms of the countries with the big trade imbalances. China's the big one, Mexico, Vietnam, Germany, and, you get down to Japan, maybe 5 or 6. But also because Japan has a lot of know-how, and it's already made a lot of adjustments in the past, has a lot of domestic production in the US. So I think Japan, among all the countries, should have a manual that it can reach for and perhaps navigate and negotiate this process a little better than some of the countries who are facing this onslaught for the very first time. So again, just end on that semi-optimistic note. Thank you very much.
Thank you, Paul. Very interesting perspective, if I may say so. Hung Tran, let's turn to you, please, for your presentation.
Well, thank you very much, and I'm very honored to be able to appear here with you, Paul and Richard. I think last year we had a similar deep dive session, and so it's good to pick up where we left off last year. First, if I may, I'd like to touch upon 2 points that Paul raised and offer my view. First, I don't think that in the current administration of President Trump, tariffs is only used as a leverage for negotiation. It may have been the case in the first presidency, but this time around, I think Trump is much more ideologically attached to it because he wants to have, at the end of the day, balanced trade relationship bilaterally with each of the major trading counterparts. And as Paul explained, and I agree, that is impossible to do because naturally the structure of economy, of society, propensity to save and consume are different. And therefore, you really cannot have balanced trade bilaterally for every country. Therefore, tariff will remain because he will never get all the countries to change their society and their economy enough to reach the balanced trade on the bilateral relationship. And therefore, tariffs will remain. And secondly, he believes that tariff is a wonderful way to raise revenue, which he will need to pay for the tax cut that will be coming soon in the budget discussion in Congress. And therefore, for both reasons, I think that going forward, even if we have successful negotiation by countries somehow to reach a compromise, there will be tariff at the very least the 10% across the board that he put, and somewhere even before, so above that. So the future tariff on a long-term basis would be somewhere between 10% and the high level that we have seen with the reciprocal rates on different countries. So that's number one. And we have to be prepared to live with that, which I agree with Paul again, will be a negative pressure on economic growth and an upward pressure on prices everywhere. So really not a good outcome going forward. Number two, as many cases, President Trump has been able to touch upon the concern of many Americans, particularly manufacturing workers whose job has been displaced, holding out of the industrial base in the US and so on and so forth. But the inequality that he described and really get a lot of resonance for many working Americans is not because of open trade. It is more because of the domestic policy and structure which divide the benefit of trade to different people, the owners of capital, the shareholders, the corporate management, and the workers. What we have seen in the US is that since the 1970s, productivity per worker has increased 3 times or more until now, but their real wages have basically been flat-lined. And that is the result of conscious policy and structure and not because of open trade. So instead of correcting the domestic structure and policy to promote equality, he really put everything on open trade and used tariff as a way to address the concern. So it gets a lot of resonance and support, but basically it will not solve the problem. With that, I move to the next point about the impact of tariffs on exchange rate and the dollar's value, and draw some longer-term implication. In the near term, we have a surprise because at the beginning of the discussion, everyone would have thought that by raising tariff, usually the country will push the exchange value of its currency upward, because tariffs mean less import will be less demand for the currency. And if it puts up price, it would cause the central bank not to cut rates as quickly as people would have expected. So basically, stronger currency. But instead of that, what we have seen so far this year is a weakening of the dollar, which is not what people had expected as an outcome of tariffs. I think that now and going forward, the focus of the markets, both in the equities and also the dollar exchange market, is on the risk of a recession globally, perhaps, but basically more in the US. And the more tariffs and counter tariffs we are encountering every day will intensify this concern about weakening and recession development. And that in the foreseeable future will be a negative for the dollar. Number three, I think that on top of this concern, we begin to see beyond tariffs, we should expect to see competitive devaluation as another instrument, another area where the battle for trade share will be fought. And that has already been raised by Stephen Mirand, President Trump's chief economic advisor, in the so-called Mar-a-Lago Accord framework, where he basically say, look, we need to raise tariffs to disrupt everything, to bring people to the table, which they have to agree to continue to use the dollar, but also to continue to support the weakening of the dollar on an ongoing basis going forward, so that will support export from the US. This is just a proposal, a thinking of Iran. It's not policy of the US government, but there's many sympathy, even with the president, on that kind of thinking of using weaker dollar to support export. But China already today has already put that in action, in the sense that it, in the fixings yesterday, fixed at 7.2 renminbi per dollar, a low level, lowest in 18 months. So I think that competitive devaluation is another part of the toolkit that big countries like China has to counter the tariffs from the US. China has said that it will respond strongly against additional tariffs. And since China import little from the US, it will run out of things to put tariffs on. And therefore, I think that currency devaluation going forward will be something that many countries would have to think about as one of the tools that they can have and they can use to deal with the tariffs increase from the US. Now, if we have that kind of competitive devaluation becoming more likely, then I think that the impact on currency market will be quite uncertain. Trading will be volatile and will be very difficult for many people. The risk there is that with the volatility that we have already seen, not only in the equity markets, but also in the FX market, very high, the risk of price gapping is also coming to the fore because of the trading infrastructure in both markets. In both equity and FX market, more and more are depending on electronic online trading, where algorithmic trading and high frequency trading accounts for more than 70% of total trading volume. And therefore, if price move down quickly, there might not be enough bids on the other side to absorb the selling orders. And we have seen in the past, crisis ensue where you have this price gap, with price coming down sharply, reinforcing the downward tendency of asset prices. So there is one development, currency competitive devaluation, and the risk of price gapping that I would highlight for currency market. The next point I would want to raise is that normally in a market stress situation, the dollar and US Treasury used to be the safe haven assets, where investors locally would run into to stay out of the market turmoil. This time around, it hasn't worked that way. Since the announcement of the reciprocal tariffs, instead of the dollar appreciating, we have seen the opposite. Year to date, minus 5-6%. Instead of Treasury rallying because of people put money into U.S. Treasury securities as a safe asset, we see yields a little bit higher now than before the reciprocal tariffs were announced. And therefore, there is some suggestion that the role of safe haven of the US dollar and US Treasury have weakened. And if that is the case, then going forward, that will have an impact on many things. It is also another example of development which are consistent with the reduction of the share of the US dollar in global reserves, which used to be about 71% in 2000, coming down to 59% a few years ago, and continue to decline gradually to 57.4% as of the third quarter of last year. And these developments are consistent with that. No other currency gain, not the euro, but a whole bunch of smaller currency, including the Canadian dollars, the Nordic currencies, Swiss franc, Japanese yen, and renminbi, kind of collectively absorb the reduction of the US share, and in particular gold. Over the past 3 years, central banks globally have bought more than 1,000 tons of gold per year. Right now, they account for 20% of the demand for gold, and gold holdings is now account for about 16% of global reserves. So again, this development, the reserve role of the dollar and the safe asset role of the dollar seems to be under question, and going forward, if it unfolds the way it has in the past few years, would have significant implication for the dollar and the trading of the dollar. And the last point I would raise also is that besides reserve currency, the dollar has retained its dominance in currency of payment, currency of transaction, with no other currency in a position to challenge it, something we discussed last year. But it is clear to me that the main challenge to the dollar is not another currency, but technology. So technology, the progress in payment technology, particularly digital payment, with central bank digital currencies, stable coins, basically tokenized units of payments that can be traded, exchanged instantaneously online, eventually will really fundamentally change the foreign exchange market. Right now, it is $7.2 trillion turnover per day. In the future, I don't see any need for that kind of huge trading of one currency for another, because technology will basically allow countries, partners to pay, to settle transactions using their own local currency very quickly, instantaneously, with less and less risk. So I think if we put all of these things together, I think in the long-term perspective, our discussion about the dollar and exchange rate will have to move to take into account of this development. So to conclude and bring back everything to the topic of the day, the outlook for the dollar. If you look at the dollar index long-term, reaching a high of around 120 in the year 2000, reaching a low of around 75.80 in the year 2010, and currently trading at 103. The dollar is exactly at the mid-level between the high and the low on the long-term basis. And as such, it is not in any overweight or oversold or overbought position on a long-term basis, technically speaking. And therefore, looking at all the different cross winds on the dollar at the moment and the average position of the dollar on a long-term basis, I do not see any compelling reason to expect the dollar to have a sustained one-way movement up or down. So with that, I conclude and happy to join the discussion later.
Thank you very much, Hung. We'll return to some of those points. Richard, please, if you would.
Hi. Do I need to hit share, or do you guys do that?
お願いします。
Oops, how do I go back? Okay. Yeah, I want to start with the slideshow here. Is that it? No, which is... Right, but I want it to show up on the screen. Oh, okay. Okay, great. Okay, good. Thank you. Hi. So I'm with Tran compared to Paul on the rationality or ideology of Trump. I think Paul, one of the assumptions of economics is that people are rational. My experience is not all people are rational. And Trump is one of them, but it's not like a broken clock. There's a method, there's sort of a method to the madness, but not that much method. So there was this illusion in Japan, or I consider it an illusion, that Trump as a businessman, sorry, a little too loud. So that Trump as a businessman would want to do what's best for the US economy. And therefore he would be reasonable, he would be a rational actor, one could negotiate with him. I think that is completely wrong. I think Trump is ideological, he's impulsive, he's emotional, he's a politics of grievance, and he partly inspires and partly reflects similar ideas among a lot of his base. He's also quite incompetent. I mean, he's not only malevolent, but right now in the United States, bird flu has killed untold numbers of chickens. As a result, if you want to get eggs in the grocery store, you got to get in line about 7:30 in the morning. And if you get there earlier enough, they're $8 a carton, a dozen, as opposed to $2 a while ago. And yet his government fired all the government bird flu scientists. And then someone realized, gee, we really need them. But having fired them, they also destroyed all the records and they didn't have any access to their email or phones. I mean, these guys are really, they did the same thing with the people who make sure our nuclear weapons are safe. I mean, the incompetence, as well as the ideology, it's kind of a witch's brew. And partly there was this view that the tariffs are a bargaining chip for a negotiation, right? The XY that Paul presented. And I respectfully disagree, and Paul could be right, but I don't think so. And we'll find out, right? I mean, at least one of us will be wrong. At least, right? So, Trump really believes, and this we all agree, Trump really believes the idea is not fairness, it's not reciprocal tariffs, it's non-reciprocal. That if you have a trade surplus, that's a profit. If you have a trade deficit, it's a loss. His goal is to get the trade deficit down to zero, except in cases where the United States has a surplus. And the surplus is good, right? If the United States has it, right? That's the goal. And so it's not like you lower. The EU just offered, and Israel just offered, well, why don't we do a 0-0 tariff? Trump said no. We pay for your military, we pay to keep you guys safe. Israel, we just have to keep you alive. You do all these mean things to us. You're going to pay us, not only for what you're doing today, but what you've been doing the last 50 years. Pay up, right? So this goal is to eliminate the trade deficit with every single country. Now, this is not only, and what's the purpose of eliminating it? That Trump believes that the reason why manufacturing jobs in the United States have dropped is because the foreigners are stealing our jobs. What you'll see here in the chart, right, is that every single, now I just did 3, but I could have done, 25. In every single country that has a mature economy, the share of manufacturing jobs as a share of all jobs is shrinking, including big surplus countries like Germany and Japan. Why? Well, for the same reason we no longer have 60% of our labor force being farmers. Because 3% of the productivity in farming has grown so much that 3% of the population in the United States can not only feed all of us, but have tons to export. The same thing is true of manufacturing. Whether you're a trade surplus or a trade deficit country. And people try to fight this with trade surpluses, but it's like King Canute commanding the waves to retreat. It's impossible. Trump believes he can not only defy the market, he can bully the market just like he can bully countries and judges and universities and law firms. He can bully the market. He's living in a pipe dream. It ain't true. The reason why manufacturing jobs, let's say automobile jobs, have gone down. Well, the reason they've gone down is that now one worker can produce as much value in automotive, in vehicles and parts as 20 years ago it took 3 workers to do. And so what happens is, so they're moving on to service jobs, to other jobs. And I did the calculations, even if there were no trade whatsoever in autos or parts, instead of jobs dropping by 30% in automobiles, they would have dropped 27%. But politically what's happened, and this is true throughout the United States and Canada and Europe, in all of the election districts, which were center-left or even left-left districts, right? Which a lot of blue-collar workers, where people have lost their jobs due to automation. People don't want to blame an impersonal force like automation. They want to find a culprit. And Trump has given them a culprit. It's them, those people from shithole countries, those people the wrong skin color, imports, and the billionaire liberal elite bringing in the imports to destroy our jobs. And so he's built up a base. This is the politics of grievance and resentment. And so this is something that people, just like people believe, vaccines cause autism. That's what's driving it. So it's ideological. Now, the fact is, what would winning look like? Say Trump actually made tariffs high enough and did everything else he had to do to bring the trade deficit down to 0. Could he do it? Well, here's the thing. When the United States is growing quickly, its imports grow a lot faster than its exports, so the trade surplus grows. When the United States is growing slowly or having a recession, we import less and our trade deficit goes down. So we can see, for example, on the left, right, where the trade deficit has expanded by more than 0.5% of GDP, the average growth in those periods was 5% a year in GDP. On the right, where the deficit declined by more than 0.5% of GDP, the growth was only 1.5%. And the biggest drop in America's deficit was during the Great Recession of 2007 to 2009, that the trade deficit declined by about 2.5% of GDP. Now, deficit right now is 4.5% of GDP. Back in the Great Recession, unemployment rose to 10%. I forget the number of the GDP drop. I don't know if you remember, Paul, but from peak to trough, but it was a lot, right? Well, he's talking about a drop as big. So if Trump actually continues his policies, that cannot be done without having a severe recession. So I think the thing that could possibly cause Trump to reverse course, possibly, is not because he gets what he wants, because that's not what he thinks. He'll never get what he wants. It's because he creates a recession that turns his base against him, and there's this political backlash. And you see Republican congresspeople in Congress fighting against deficits because they understand what it's going to mean for jobs. Someone just said it's going to cause auto sales in the US will be 2 million sales less because of these high prices. Now, why do we run a trade deficit in the first place? The assumption of the Trump administration is the only reason we run a deficit with any country is because they're cheating. With currency devaluations and non-tariff barriers and this cheating and that cheating and the other cheating, all right? It just ain't so. The reason we run a trade deficit is really quite simple. If you want to eat 4 fish a day, you got to catch 4 fish. You can't have 5 fish a day if you only catch 4, or can you? What if you got a neighbor over there and you buy the extra fish off of him? Now, even though you're only catching 4 fish, you can have 5, you can eat 5, right? Well, how are you going to pay for it? Well, you borrow the money from him and you pay for it. That's what the trade deficit is. So the dark blue area, GDP, that's what America produces. The light blue area is what we consume. Now, consuming, C stands for personal consumption, I stands for business investment, G stands for government spending. You put them all together, and we see for year after year after year, we're consuming 5 fish even though we only produce 4 fish. And the countries that are on a surplus, it's the opposite. They actually are unable to consume all that they produce because of low wages or other reasons. That's why. So how are you going to solve the problem? You've got to erase that gap. And the only way to erase the gap is to reduce the light blue line. But when you have less consumption, if the government cuts spending, and you have high tariffs that cut personal spending, and then companies don't invest as much, you send the economy into recession. So that's what he's going to do if he persists. And I believe he will persist, unless there's a political backlash from recession. But it's certainly not, oh, gee, if you have tariffs the same level as us, we'll be, we'll have achieved what we want, we'll be okay. He will never be okay. Now, what does this mean for the dollar? Well, the dollar is facing contradictory forces. I don't believe, with all due respect to forecasters and really, really smart people, much smarter than me, I don't believe they have any idea what's going to happen to the dollar, because they cannot predict what's going to happen to the forces that determine the value of the dollar. On the one hand, if we actually reduce the trade deficit and we have high tariffs, that would reduce America's need for foreign currencies. That would cause the dollar's value to rise. Their value would drop, our value would rise. That would push the dollar up. On the other hand, foreign countries send an awful lot of money to the United States to invest in American stocks and bonds. It's the mirror image. The other side of the coin of the trade deficit is the financial inflows. If people see that the trade deficit policy, the non-reciprocal trade tariff policy, is going to cause America's growth to tank, then they will not want to invest in the US, and that will send the dollar down. And nobody can tell you which force is going to be stronger. They have educated guesses, right? But if you actually look at forecasts over the last year or two, they don't know what the Fed is going to do. I mean, they just don't know all the factors. They can explain it in hindsight, but predicting, they've been lousy forecasters on this thing. As Yogi Berra said, predictions are hard, especially about the future. Just in the interest of time, I'm not going to talk the Mar-a-Lago Accord. Just to say, one, I looked it up, as far as I can tell, it is the idea of one guy. It is not being discussed within the administration. So it's kind of irrelevant. It's also really nutty. It's internally inconsistent. It's just, if people want to talk about it in the Q&A, we can, but I just would not pay attention to it. Now, what does this all mean for Japan? Japan has been, over the last 30 years, extremely sensitive to economic shocks, right? Which is, we've had, whether it be internal shocks or external shocks. So you get 6 good years, right, which are the taller columns, and then 6 bad years. 6 good years, 6 bad years. So we got, in the beginning, the lost decade, it was considered lost because growth fell to 2.4% a year, having been 4.5, even 5 some years. Then you get 97, we get the Asian economic crisis, we get the tax hike and the consumption tax, we get the banking crisis. The next 5 years, basically almost no growth at all, right? The tiny little line. Then we get recovery from that and the first years of Koizumi, and people are saying, yeah, baby, we're back. Japan is back. And we get this grand total of 1.9, less than 2.4. But then we get 2007, Great Recession, global slump, whatever, which Japan was not the cause of. Japan didn't invest in all these crazy derivatives, but nonetheless it's hit by it, and we actually get negative growth, right, for 5 years. Then we get Abe, and now we're back again for 6 years, where it's 1.4% growth. And then we get the second consumption tax hike, we get COVID, whatever. Again, COVID is actually not that big a deal in Japan, but the consequences, because Japan's dependence on the kindness of strangers. Again, we get virtually no growth for those 6 years. Now, before Trump arrived, the IMF was saying for the next 5 years well, this is but it goes to 2, no, not 29. I didn't change the label, I'm sorry. They were predicting an average per capita growth the average total growth of 0.7 a year, right? Which is really, that's not the big recovery we had before. It gets worse and worse and worse. That's before Trump. The Daiwa Institute of Research says that if Trump continues these tariffs through 2029, that GDP in 2029 in Japan will be 3% lower than it would have been in the absence of Trump, which wipes out about 3/4 of the growth that even the low growth that the IMF is predicting. So Japan is really, really vulnerable. The second reason why it's vulnerable is that, and this I think is not sufficiently understood in Japan. This is, by the way, the Daiwa numbers, all right? Which is there's a direct effect on Japan of the tariffs. So Japan's exports to the United States of automobiles and auto parts is 20% of Japan's entire global exports to everybody. So that's a big hit. That's a really big hit, right? But the thing is that Japan is going to get hit hard by the tariffs on China, on Korea, on Vietnam, and Southeast Asia. And here's what happens. What does Japan export to China and the rest of Asia? It exports machinery that helps build stuff that these countries then export to the United States and Europe, and parts, ingredients. So the United States, we buy a lot of computer chips from China, but from Japan. But they don't come to us saying made in Japan. They come to us in a smartphone that says assembled in China, right? So if the darker bar on the left is what's the correlation, what's the dependence of the ups and downs of Japanese exports to China to China's own internal growth, is 50%. What's the correlation between Japan's exports to China and China's own exports to the United States? It's 75%, which means if those exports tank Japan's exports to China, which is about 20% of its total exports, they're in trouble. The same thing is true of Japan's exports to Korea and Southeast Asia. But the one on the right, this is the really fascinating thing, which is the one with the diagonal lines. This is what's the correlation, the dependence of Japan's exports to Korea's exports to China. And the more that Korea exports to China, I'm sorry, not exports to China. What is the dependence of Japan's exports to Korea to China's exports to the United States? The more that China exports to the United States, the more that Japan exports to Korea to help support the Korean exports to China. These are incredibly delicate supply chains. An iPhone goes, I think, 40 times cross-border, sometimes the same thing. All the cars of what happens with Mexican cars. Trump has no idea. He says, well, gee, the prices could go up, people will switch to the Americans. They can't do it. He says, we're going to double the amount of factory jobs. Factories cannot hire the number of people they want today, and they're going to double the number of jobs. They don't have the mechanical engineers. They don't have others. What am I?
You've got another 5 minutes.
Really? Wow, baby. Okay.
4 minutes.
Okay, so here you go. Japan tried to, under Abe, what Abenomics was really about was not 3 arrows, it was 1 arrow, which was monetary policy, and monetary policy worked by depreciating the yen. 80 to 90% of the entire increase in Japanese prices since 2012 were import-sensitive items like food and energy. It was the depreciation of the yen. It wasn't the healthy kind of inflation the Bank of Japan thought it would be able to create. Now, worse yet, Japan has become so much less competitive that here we have, since 2018, there's been a 27% depreciation of the yen. So that should have allowed Japan to export more, import less. But what we see is that exports and imports actually went up by a similar amount. The light blue is real terms. Then there's the numbers of cars, the tons of steel, the new amount of machinery, et cetera, right? So those went up more or less the same. So the real volume of exports didn't change despite this tremendous depreciation. And one reason is because Japanese companies are becoming less and less competitive on the world market. They're very poor in using digital technology. But now you get the worst side of it. The dark line is how much did Japan pay? And there we can see, yeah, the prices for exports went up, the blue line, which is great if you're Toyota or you're Nippon Steel. But what about the imports that people use to buy food and clothing and energy, et cetera? They went up even more. So you basically had a transfer of income from Japanese workers and smaller companies to the blue chip exporters. It was a ripoff, and that's why there has been this incredible backlash, and the government is now trying to stop the depreciation of the yen and have it reverse because they're getting a political backlash from it. The plan did not work. Too quickly. One is, here's the foreign content of cars. You can see, except for Honda, there's a huge amount of foreign cars in Toyota, Nissan, et cetera, as well as the Detroit. The car company's gonna get smashed by this. And then finally, this is the final point, which is that there's a really strong correlation, which we see in the trend lines, between the gap between American interest rates, the 10-year government bond in the United States and the 10-year government bond in Japan. And that's the trend line right here. Does the cursor? No cursor, oh yeah. So that's the trend line. This shows the bigger, the horizontal is the size of the gap. So the bigger the gap, right, then the stronger money is lured to the United States, the stronger the dollar gets, the weaker the yen. And we see these two lines, the one on top is 2001 to 2012. The bottom line is since 2021. So even though the slope of each line is the same, why is the line for the last 4 years so much lower than it used to be? That means for every gap, for every, if the interest rate gap is such, it would have been, the yen would have been 140, I would say 110, today it's gonna be 145. It would have been 100, it's gonna be, again, 26 points weaker. This is because the Japanese companies are less and less competitive. They have to sell at cheaper and cheaper and cheaper prices just to get people to buy their stuff. That is not the route to national wealth. It doesn't work for Japan, trying to get richer by depreciating your currency. It will not work for Donald Trump. So on that note, let me stop. And thank you for your generosity of time.
Okay, thank you. Richard, by the way, has to leave promptly at 10 o'clock. So he's kindly said that I can give his email address to anyone who has follow-up questions if they don't get them in the session today. Right, we'll turn now to question time. I want to ask one quick question to the panel for brief answers, and that is this or is this not a turning point? What I mean by that is Paul has said that the tariff impact will lessen or disappear within 6 months or so, but at the same time he says the rest of the world has to change. So my question is this arrival of Trump and his policies really going to trigger a structural change in the world economy, in Japan's partners, for instance, which will alter the situation whereby the US has been the chief dynamo of global demand, or is it not? I mean, and also, how far can the impact on markets go? You've both of you, or two people have said that the dollar won't shift all that much, but do the stock markets have very much further to fall? Sorry, rather a long question, but Paul, if you wouldn't mind addressing that.
Well, very briefly, I think was the request. Again, maybe just throw in something a little bit contrarian, maybe. The one thing I'd point to, issue that sort of hasn't come up and sort of seems like couldn't be true, is that there is probably more continuity between Trump 1, the Biden administration, Trump 2.0. In other words, again, it's very easy to get mesmerized by the individuals, by the whole sort of narrative around these shifts. But what I'm referring to is, a shift. There's been a very broad structural shift in the last 10, 15 years, where essentially national security issues and geoeconomics have become intertwined with economics. And so to a large extent, the sort of normal, sort of traditional economic arguments that economists like us would make sort of being hijacked a little bit and having to get in the back seat. So that's just one point. Again, it sort of speaks to my point a little bit that this is not just all about Trump. There are these broader forces at work. Now, for example, what I mean by that? Well, when Biden came in, he didn't remove the tariffs that Trump had put in. Would have been an easy thing to have done. So that was a Trump policy, get rid of them. He kept that. In fact, if you listen to the Biden administration in the early days, people like Jake Sullivan and others, he talked about we need a foreign policy for the middle class, kind of rather, in some ways, kind of a little bit Trumpian in a way, although MAGA maybe is not as middle class, but whatever. There's a certain class aspect here. If you look at the CHIPS Act, you look at the misnamed, poorly named Inflation Reduction Act. So this whole sort of debate and reality has been building of US having an industrial policy, of national security issues being intertwined with economics, with a much more kind of, nearshoring, onshoring, friendshoring, that whole sort of box of tricks. So I would look at it a little bit in that direction, in that spirit, that there are forces at work here at play that need to be managed, that are coming to the surface in a very kind of, in many ways, kind of shocking way with the Trump drama, but the underlying issues were sort of there and were probably going to keep making themselves manifest. But a lot of it does depend on this issue that we kind of disagree. And again, I'm not thumping the table on this. I'm offering a point of view. I think I'm right, but I could well be wrong, is that I do think that this, these tariffs will, 6 months' time, we'll be talking about something else. I don't think that most of them are permanent. And one of the things, if I just slip in here, a reaction to some of the things I've heard, is that sort of good news on this front is that Donald Trump is not a numbers guy. So Richard is completely right, and Hung, and I think I said the same thing.
Well, just stop there.
There's no way in the world that bilateral trade deficits, let alone the overall deficit, is going to come to zero. So if that really is Donald Trump's objective, and he's focused on it, and he gets up in the morning looking at how are we doing today, then we're all like baked. But I think he's going to be looking at things like announcements of investments in manufacturing production. And if he gets around to data, it might be just to look at some of the manufacturing jobs data. So it is possible that everything that we're witnessing at the moment does lead to a little bit of an increase in manufacturing jobs. It's 8% of employment at the moment. It's a historic low. Maybe gets it up to 8.2, 8.3, whatever. But then you're talking about tens of thousands of jobs. Now, tens of thousands of jobs, or thousands of jobs, monthly payrolls are about 200,000, 250,000. So, 50,000 manufacturing jobs is actually a drop in the bucket of the US economy, but you will hear no end of it. It'll be in every speech, et cetera, et cetera. So I'm much more sanguine simply because I think Donald Trump, and the other thing is the feedback mechanism, that the more that we forecast the economy is going to go into recession, the stock market's going to fall, Donald Trump is not going to like that. And he wants a booming economy and a booming stock market. And I don't think he's ideological in the sense that he's going to stick to this policy come hell or high water. I think he's a little bit more pragmatic, but wants to be able to declare victory.
Richard, briefly.
Yeah, one is, okay.
Come to you.
Sorry.
Well, I think Donald Trump is not only ideological, I think he's also self-deluded, and he likes it that way. So that's just one, it's a difference how we judge him, and we'll see. Look, there's an expression that you can turn an aquarium into dinner, but turning a dinner back into an aquarium, it ain't so easy. And I think we are moving into an anarchic world, that the stability of the international economy and finance, et cetera, depended upon the United States playing that benign hegemon role, getting cooperation with China on some of these things, that we had a great recession instead of a Great Depression, partly because of that. We're losing that. We're losing where our allies no longer think of us as reliable either on economics or security. We've not had a lot of the wars. The idea that France and Britain, which have warred against each other for centuries, don't have wars is because of the U.S. hegemony after World War II, and we're in a different world, right? We're going backward on that. I think we're in for a very rough ride, and this Paul and I agree on. I think Biden, in many ways, the lesson he learned was, in order to win the elections, you got to be Trump-like, Trump without the vulgarity. And without the extremism. I mean, Biden would never have done. Trump likes to knock over chess tables. So he's completely extreme, and he's hired, unlike the first term, he's hired no one who's going to at all sane. who put guardrails on him. He's just on loose. I don't think we're going to go back, even if he disappears in 228, which is in question, I don't think we're going back to the pre-Trump 2 for a long time to come.
Okay, thank you. Hung, are you similarly optimistic?
Well, between Paul and Richard, I tend to share Richard's view in the sense that we really live in pivotal time, in the sense that the post-war liberal, open, rule-based order has collapsed, and instead we have bilateral reciprocal dealing between countries, in which, of course, the strong countries are in favor, and the weak countries will have to find a way to compromise or to change to meet the requirement of the stronger countries. And therefore, the change relative to the trade imbalances that President Trump tried to address will vary from country to countries. Big one like China is in a position to push back and to fight, and therefore they will come to some kind of compromise with some give and take. But the smaller countries really have no choice but to really yield to a lot of demands from Trump. I take the case of Europe, EU. So the complaint from President Trump vis-a-vis the EU is not only their tariffs is higher than US tariffs on average, but a whole host of domestic policy choices reflecting the preferences of society and citizens and voters in Europe. Value-added tax and national sales tax. Trump count that as disadvantageous to U.S. goods. They have to change. Are they prepared to change that? Border climate adjustment mechanism to make sure that there's a level playing field between high requirement on European producers and foreign producers. And from U.S. point of view, that is discriminatory to U.S. goods. Will Europe be in a position or willing to change that, or own the other regulatory requirement regulation on digital services, digital markets, and digital tax? Will Europe be in a position wanting to change that? Those are very difficult issues, and I don't think that Europe is prepared to change all of that. And if they don't, then of course the complaint remains, and therefore tariffs will remain. So we are really in a situation where we have endless series of bilateral negotiation, bilateral dealings, reciprocal outcome, managed trades, and basically the strong U.S. is strongest economy is in a very, very favored position compared to many weaker countries. And China is the only exception.
Okay, thank you. Yes, lady there, please. Sorry, working press first, please.
Is this working? Hi.
Is that working?
I don't think. Thank you for taking my question. Cody Ida with NHK. Is it
I
working?
think it's working, actually.
Okay. I have a question on the currency. Secretary Bessent earlier this week on social media said that he wanted to engage with Japan on the currency issues. What do you think the currency issues are? Do you think this is the Mar-a-Lago Accord that people have been talking about? And also, can the U.S. maintain its status as a reserve currency and also trying to depreciate the value of the dollar? Can those two go hand in hand, and how would that work?
Okay, Paul, you.
Oh, okay. Yeah, I usually punt questions on the currency because somewhat similar to Richard's perspective, and then I would invoke the kind of impossible trinity that basically we operate in a world in which we have flexible exchange rates, we have open capital accounts. They haven't come under much attack so far in this whole discussion. And then countries are able to have their domestic monetary control. So the reason the Bank of Japan can do its monetary policy and the Fed can do its monetary policy kind of independently is because we are in this flexible exchange rate regime. So exchange rates will move in all kinds of ways, often unanticipated. It's not really a policy variable. Having said that, of course, people might point to the Plaza Accord and then the Louvre Accord of the 1980s. How much of that was clever timing by the policymakers who got around the table and said the right things at the right time, and how much of it was actually moving financial markets in a very, very dramatic way? we'll never know. We can't run the counterfactual. But I'm a little bit skeptical that that kind of jawboning or coordinated kind of G7 would.
Mean by when you say currency issues?
Well, I guess he's probably talking about the yen is too weak. There's been a kind of a competitive devaluation, and the dollar is too strong. I mean, Stephen Moran also, I think, the kind of person behind this Mar-a-Lago Accord idea, in one of his interviews recently was asked, is this on the table? And his response was, well, not yet, basically. So I wouldn't be surprised to see, and again, Donald Trump, if somebody whispers in his ear, you could have the Mar-a-Lago Accord, which would be basically, a weaker dollar, but not too weak, against other currencies, and you go down in the history books as solving the problem, because if tariffs don't work, which they won't, what's going to be next? Then maybe it's something around currencies. And again, this is kind of one of these issues where Donald Trump will claim victory if you give just, you open that door a little bit. And that's, for me, is the saving grace, because otherwise, if he is fixated on this and is going to go the whole way, then we are in this world that Richard and Hung are talking about.
Okay, quick.
Yeah, listen, the Plaza Accord worked because there had been momentum investing in currency markets. It was like a currency bubble. So when the currencies move far away from the value that fundamentals say they should, or the range of values, then coordinated intervention, coordinated policies can work. Because now you're bringing the value back to where, more or less, where it should be. That's why it worked. That's not the case today. The currency is reflecting various kinds of fundamentals, interest rates and growth rates and all sorts of stuff like that. We're not in a speculative frenzy. So this is, again, another area of just self-delusion. Now, yeah, if the Bank of Japan raised, interest rates to 4%, yeah, that would, that would have a stronger yen. It would also mean a huge recession in Japan. I mean, it just ain't going to happen. That's what I'm saying. This stuff is really, it's bonkersville. It's like firing the bird scientist and should not be taken too seriously. People are trying to see what's the grand plan behind this. And people have got different plans, but it's nuts. It's really nuts.
Okay. Hung, brief comment.
Well, I think that like Paul and Richard, the U.S. administration looks at things the other way around. The fact that trade deficit exists is to them prima facie evidence that the country either cheat or do something non-tariff barriers against U.S. goods, or maintain artificially weaker currency than should have been the case, because only through those mechanisms can they have the trade surplus with the U.S. And therefore, the fact that the U.S. has deficit means all the country maintain too low value for their currency, then they have to correct it. And I think that is a view shared by many in the U.S. administration at this point. So I think that whether or not when we get to from tariffs to weakening of the dollar on a grand scale is a matter of time.
Okay, thank you. You raised your hand first, please. Keep your question brief if you don't mind.
Thank you very much.
Identify yourself, please.
I'm Andrea Gerali from the representative office of the Bank of Italy in Japan. I wanted to go back to the two ways of getting out of the current situation. One is Paul Ways, the geopolitical way, let Donald Trump declare victory. Then there is the richer way, which is the real side of things. There's going to be a recession, and then he has to. I want to point out a third way of getting out, which is the let's trust the moment for the U.S. Treasury. There could be a sudden increase in the spread and decrease of value of the U.S. Treasury because investors might try to question the current trajectory, and if that U.S. Treasury are the preferred instrument of choice in so many leverage positions throughout the financial system worldwide. So if the movement happens fast enough, some of the positions will simply go insolvent or straight out bankruptcy. And that is one way in which the financial crisis that will erupt will convince Trump to tame his most wild instincts.
Okay.
I want to know what you guys
Quite a
think
few
about.
points there.
Yeah, very quickly. If I understand what you're saying that people would flee the U.S. Treasury bonds and so the interest rates would drop.
The interest rate will go up on Treasury and the
Oh,
value of the
abandon-
Treasury
I
will go
see,
down.
I see.
And then all those leverage positions will be insolvent all of a sudden.
Well, yeah, that is a real, but that is the kind of thing that the impact of that would be increasing the recessionary pressures. So I think it's not the financial crisis per se, I think it's the unemployment and the inflation.
Yeah, and just one thing to bear in mind here, not that it is a foolproof solution, is when we're talking about recession risks, etc., the Fed's job is to prevent that. So also when it comes to financial instability, the central banks and the financial stability authorities, now they may not be able to be very effective, but they will be trying to prevent that calamitous situation from happening. So we have to factor that into the picture as well. And then so Donald Trump may get his low interest rates because he wants low interest rates, right?
Okay.
Well,
that's one way to get them.
Yes. Yeah. Well, yeah. First they're up and then they go down.
This gentleman at the front here, because you are working press, I know. So.
My name is Takuya Nishimura, freelance journalist. Do you think Trump can maintain his public support in the United States on his tariff issue? Do you see any impact of the midterm election next year on his decision of the tariff, and do you expect any adjustment until the next year's election?
Well, I think when we talk about public support for President Trump, it's bifurcated. I mean, obviously, many people, 75 million people or so, don't support him. 77 people or whatever, 77 million people voted for him at the last election. That was enough to become president. I think that MAGA base will be quite strong, for quite a long time. But again, a lot of this will unravel at some point if the economy goes into recession. But I think for the moment, that part of Trump's base is pretty strong. Now, of course, Trump, I don't think he'll run again. But he's not going to have to run again. So he's facing different dynamics, political incentives from the first term. But we do have the congressional elections. And yes, I mean, if we're in this recessionary kind of situation, financial crisis, it looks a mess. And Donald Trump's reputation is in tatters, and he's the emperor with no clothes. The Republican Party are going to they're looking at the midterms. They're saying this is a lame duck president, and a lot of this could unravel. So I think that's part of the reason that Trump is moving so quickly. He's trying to get as much done and give himself some sort of runway to react if things don't work out the right way. But
Thank you.
Could you tell me very quickly?
Sorry,
okay.
Quickly comment on that. Can Trump survive, or will he be assassinated?
Well, I think that I agree with Paul that the basic MAGA support for President Trump has been very solid, very strong, and will remain. And basically, throughout the years, it's around 47% of the electorate. Now, the marginal votes, the independent votes, are what counts. So if they can really be pushed in a way, looking at the declining stock markets, looking at the risk of recession, lower economic growth, higher unemployment rate, and high inflation, and sour on Trump, then there's a possibility there for the Democrats. So at this point, it's really the independent votes.
Okay.
Just the polls show that even among Republicans, they believe that the tariffs are going to raise prices, and so that they're actually not happy with this. Now, whether the Democrats can take advantage of this, that's the issue. Right now, they seem really just divided, hapless. They don't have a strategy. They're not moving well. So I'm not going to say anything about the elections 2 years down the road.
Okay. Yes. As brief as possible, please. We are running.
I am Cody Ellingham of the Transformation of Value independent media. Tran mentioned the role of technology as playing a major role in the future of the dollar, as well as the returning interest to gold in conversations about reserve currencies. Richard mentioned we are entering into a more chaotic world with Bitcoin in particular, which has a fixed supply, no counterparty risk, no issuing government. It's becoming more and more established in the legacy world as a kind of exit valve. How do you see Bitcoin potentially disrupting the dollar and fiat currencies globally?
Okay. Richard first.
Well, first of all, crypto consumes so much electricity, it's a major contributor to global warming. I think it's a scam. Trump was against crypto, and then he got lots of money from the crypto producers, and he established his own coin, which he's made, I don't know, tens of millions of dollars off of. And part of the Mar-a-Lago Accord is introducing crypto as part of the reserve thing, so more money for Trump. I mean, it's an incredibly corrupt administration.
Okay, Paul.
Yeah. Well, I think Bitcoin, blockchain, all these cryptocurrencies are major disruptors to the system, so it's just they will have an effect. I don't think they're going to replace any of the sovereign monetary system that we have, but they will disrupt it. Stable coins is one element of that, but stable coins generally are track the dollar. They're stable against the dollar, so it's still within the dollar reserve currency system in a way. But then you've got all the CBDC, the central bank digital currency kind of developments. But I like what Hung said before, that this, and if I put it in my words, there's something sort of quaintly anachronistic about this whole concept of needing a reserve currency. And if you listen to the arguments why you have a reserve currency, they usually are around, well, there's transaction costs and there's sort of coordination costs, and so this currency is kind of convenient. But technology these days just should be sweeping a lot of those cobwebs under the carpet. So it's a little bit of a mystery to me why we still have this reserve currency position. The other thing just hasn't really come up, but if I put a negative thing on the table, I'm on the public record as very negative about the way in which the dollar has been weaponized. And if you do want to lose your, freezing of reserves, shutting countries out of the SWIFT system, et cetera, if you do want to lose your dollar, your reserve currency status, not in the short term, but in the medium to longer term, that's a pretty good way to go about it. And that's not the Trump administration. Of course, that started with previous administrations, got a shot in the arm under the Biden administration, and probably, I think Trump would continue that.
Good points. Hung, quick comment?
No comment.
No comment.
Agreed.
That's very quick. Okay, well, we are actually, unfortunately, time is our enemy as usual, and that brings to an end what I hope you have found to be an interesting debate. There's obviously a lot more to be said, and perhaps we'll have a future event in 6 months' time when all our troubles will be over, hopefully, or not. Okay, well, let me thank our panelists, and let me, as is our custom, offer them 1 year honorary memberships to the club. Richard,
Thank you.
Your honorary membership. Paul Edge, and thank you. And Hung, I can't hand it to you, but we'll send it to you. So please join me in thanking our panelists.